The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. Guy Allard, my co-host. How you doing, Guy?
I'm doing good. I'm sitting here thinking if we should share with that's a rarity. No, if we should share with our listeners about last week's show. You know, when we do the shows, last week Victor had a real estate deal or something he was working on, so he couldn't be there live on Saturday. So we recorded it in the studio, and try as we may, all shows aren't equal. Some are energetic and really good, and others, well, okay. Last week was a great show. What happened?
I think it got deleted.
We ran a rerun. In the process of being edited, our engineer, I think, transferred it to an MP3 or something prior to saving it, and we lost the show.
So, sorry about that rerun last week. It was too late to catch it once we caught it. But
good news is we're prepared for
that's
today.
Right.
That's right.
We already have the information ready for this show,
right.
Remember, our whole philosophy here, we're going to talk about behavioral finance today. And it really translates right into our philosophy. You know, our philosophy is if you've got a certain amount of bills, monthly bills when you retire, pay for those with a guaranteed income stream. Once you have that guaranteed income stream, then you're free to do things like the stock market. We love the stock market. After the bills are paid, I think it's a great place. It's the only thing that's beating inflation over time.
We have some great managers that do a really good job if you want to be in the stock market and for that part of your portfolio.
The stock market was never designed to be a monthly bill payer. It was designed for long-term type of growth, if you can stand the ups and downs of the market, and it's really good at fighting inflation long-term. And the short term, you can't pay the bills.
That's right. Sorry to walk on you there. Right. And the reason it's not good for a bill payer, although you can do it, is you always talk about the monthly averages. Unfortunately, the last, 10 or 15 years, the S&P with dividends is about 4%. Usually it's better. You hear a 10% number. Those are averages, right? Some years you lose 10 or 15. Some years you make 30, but it's an average. And if you stay in it, you're doing fine. But when you're in the distribution phase, and you're withdrawing when you lose 15%, well, obviously that 15% is now maybe 20. And if you're withdrawing when it goes up 20%, it's not 20 now because you withdrew. It's probably 16, and it really messes up the averages.
Yeah, averages mean nothing when you're in the distribution phase of your life. One quick example, if you got $1 million and you're taking out $50,000 a year, okay, market drops 50% like it has twice in the last 15 years.
Right.
You got $500,000 left,
right?
And now you took out your 50. You still got to pay the bills, right?
$450 left.
So you got $450. It can't make enough to catch up. I'll give you an example. Let's say the next year it makes 20%. So you made $90,000, right? But you had to take 50. It's another year of bills. So you end up 40. So now you got what? $490. And so it's a death spiral you can't get out of. So I don't care if that market or that mutual fund averaged 9-10% for 100 years. It doesn't matter. All it takes is one down year. I see retirement plans all the time. They usually come from a mutual fund company or a wirehouse. They're saying if you'd have just chose this basket of mutual funds, not saying that they chose any of those mutual funds because they're always back traded. Well, if you would have owned these during these times, but that means nothing for the future. You can't count on the market to pay the bills. Nothing wrong with the stock market. We love the stock market. We've been managing people's money in the stock market for decades. But our philosophy is have the bills paid. What it does, it allows you to get through a down market without having to sell everything at a loss, okay? Even then, though, I'm more conservative. My biggest thing is don't lose money. You know, if you're in the market, great, just don't lose money.
Two things. One, the problem with those averages is it gives you a real false sense of security. It's averaging 10%. Well, I don't need 10, but I can take 8% because it's averaging 10. The corpus, my balance will still grow. Well, that doesn't happen.
I looked at the It was Ken Fisher still, Why I Hate Annuities. And remember, that's the greatest marketing ploy in the world. I've never heard of one better. Everybody goes, well, why do you? It's fantastic. The man has been in business 40 years. He's tripled his assets under management in 3 years of doing the I hate annuities and why you should too. Help me get out of your annuity. I'll pay your penalties. He doesn't really pay your penalties. He just adds it to your fees for a few years.
Everybody knows about that.
But even then, if you take out 7% a year, he uses the S&P 500 and a bond, some bond index as an example. But if you take out 7% a year, you got about a 20% chance of survival. Now, how is that? Wait a minute. The stock market's averaged 9-10% for 100 years. And if you take out only 7, he's saying if you're all in the market, you still got a 20% chance of survival. 80% chance, you've always heard me say it, you're eating cat food when you're
Your funds are exhausted.
But so even that will tell you, I'm just not that aggressive. If I've got a 50% chance of eating cat food, I'm going to do something about it.
It's too high, isn't it?
Way too high. Now, it's your choice. Let's say I've got a 90, 85, 90, 95 chance. I'm okay. The only problem you got to be careful with is when you see these illustrations on mutual funds, they've back traded a mutual fund on purpose. So it might work into that scenario. I had one come up the other day. It was just a regular balanced mutual fund. And it said, well, you have a 99% chance of not running out of money. And I said, this is the biggest bunch of hooey I've ever seen.
Right.
Because if that mutual fund just makes even 1 year, the whole plan's wrong. Because they took a mutual fund that hadn't had any losses over 10 or 20 years. But that doesn't mean it can't just die. I've seen them go for 20, 25 years. Remember the dividend producing stocks. Everybody says they can't go down. Well, the average dividend producing stocks, these are like the, what's it called? Oh, it's a volatility index just on dividend stocks from the Standard & Poor's. Aristocrat index.
There you go.
And that takes the top 25 or 40 dividend paying stocks that have increased dividends for 25 years in a row. They still lost like 40% before. So you can't rely on that to pay the bills. You have to have something else.
And the whole point is if you believe and subscribe to that philosophy of making sure your bills are taken care of, aside from the security, which gets into the behavioral finance, which is a big plus, but it takes the burden off of your other funds. You can sit through ups and downs and all the problems that you may have with the stock market so that you can get that average return. And you would be surprised, perhaps, depending on your needs, monthly income-wise, how little it may take to accomplish and just lock that up and guarantee it so that the other money is there to do what you need to do.
And the more you can think about it in advance, the more sense it makes too. Because doing it today, I need income right now, is going to cost you this much.
That's right.
If you can do it for pennies on the dollar by doing it 5-10 years in advance. Hard to do, but it's for those forward-thinking people that understand, hey, I want the bills paid with a check coming into my bank account every month. I want that check not to be dependent on what the stock market is or isn't doing, or what interest rates level, what they are or aren't. I want it to come in no matter what. Now, a lot of people say, well, I don't like annuities. Well, I hated them too. I was the biggest opponent of annuities for a long time until interest rates got to where they are and the stock market got as volatile as it is. Now, if I could buy, 10-year bonds, 10-year government bonds, and I could get 6-7% like they were several years ago.
Absolutely.
I'm more interested in that.
Yeah.
But you just can't. If I can get this 8% CD, I'm really interested in that. I'll be ahead of you in the line to buy them when they come out, right? But they don't exist and haven't existed a long time.
And the other thing, too, and what Victor's talking about, obviously, if you need income right now, you don't have the time for deferral. But the other kind of magic number, if you will, is 70. Most of us, if you want to retire at 62 or 65, you want to get the income coming and all of that. But as you're probably aware of, if you can wait to 70, your Social Security increases about 8% a year from your particular full retirement age to 70. And it also would give these, let's say, fixed annuities a chance to mature and grow and defer so that you could get a bigger number there. Like I said, it's a magic number. It's something to shoot for. May or may not work for everybody.
And also, remember, we offer complimentary, no charge, and no obligation, even more important. We can do a retirement plan and stress test on your particular portfolio. It will show you what your life is going to be like 5 years into retirement, 10 years, 20 years into retirement. It can show you, what if one of the spouses passes away? Does the other spouse have to eat cat food at a certain time, right? What about inflation? how does inflation affect your finances over time? How does it affect your purchasing power? In other words, if you have this many bills now, what's that bill's going to be? Not by adding new cars every year, just the same exact bills. What are they going to be 20 years from now? It will show you all that. It'll show you the cost of living adjustments on your Social Security, even though they seem to be getting pretty skimpy lately.
Skip one here recently?
They skipped 2 out of 5 years. It's only skipped 3 times in 100 years. So, not 100 years, but 70 years they've had Social Security.
Hey.
So, but that's what I'm telling you. Everybody just can't go blind. In other words, well, I think it'll be okay. I remember thinking when I was a kid, if I just save $1 million, I'll just live off the interest and be rich forever.
That was a big deal.
Right. Now, if you can live on 1% CD, $10,000 a year,
Yeah.
it still works for you. Other than that, it doesn't. And so that's why this plan is so important. Don't hesitate to call us. We'd like to take advantage of it. 972-715-2424. Again, 972-715-2424. Or go to ilovemyretirement.com. After the break, we're going to talk about behavioral finance, and I think it's really interesting. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. Remember, if you have any financial questions, you'd like to take advantage of our complimentary, no obligation retirement plan, retirement stress test, and Social Security Optimizer. Remember, there's been some changes to Social Security here, I think, last November? Yep. They eliminated some good ones. But there's still some good strategies out there. And this will show you exactly in your particular situation what is the best thing to do with Social Security. Everybody thinks it's always, well, they're going to tell me go to 70. It's not always that at all.
No. But they did close a nice loophole.
Oh, yeah.
Darn
So
it.
don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Or go to ilovemyretirement.com. Why do we call it I Love My Retirement?
Because that's the point. When your bills are taken care of and you don't have to stress, you'll love your retirement.
I'm telling you, in retirement, now, of course, I have little kids in my 50s, so it'll be, 40 years from now.
Yeah, 70 is not your magic number. I think it's 80.
Magic number, they're still in high school or something. But, no, retirement is not me worrying about what the stock market's doing, looking at my portfolio every day, worrying about, oh, my gosh, if I don't get another 1% on a CD, what am I going to do?
Yep.
I just don't want to see that. I want to see I got 10 grand a month in bills, 11, 12 coming in, and that increasing with inflation if possible.
And we have something like that now, too.
We do.
We've talked about this a number of times. How great would it be? Actually, I know a lot of people that would never even go to work if they could get a paycheck and not, right?
That's right.
So that's kind of the philosophy.
You're buying yourself a retirement paycheck.
That's it.
All right. Let's talk about the enemy of anybody managing their money. Even if they have an advisor, this is going to interfere 90% of the time. And it's emotion. You've got to fight your own biases and you fight your own instincts when it comes to investing. Because it's always, you're always illogical and emotional with your money. It's worse than politics or religion. It's bad and it's normal.
Even if you're really good at managing, we work with a lot of folks that will manage part of their funds. They manage some. They're good. We've talked about the engineers and the spreadsheets. But one of the advantages of having someone help, a second opinion, an advisor, a wealth manager, all of that stuff, is for us, it's not emotional. It's all about the math. And what we do is we run the models, we do the math, and then we show it to you. And then you make the choices.
Right. And think about this. Even if you're the perfect money manager, in other words, you manage your own, you only do index funds, ETFs, individual stocks. You're not going to pay anybody a fee, for God's sake.
Right.
But is your spouse as up on this stuff as you are? Sometimes it makes sense to have an advisor on the side, even if you do most of it, because there's a trusted advisor your spouse can go to in case you can't do it anymore, or you get a time where Alzheimer's kicks in and you don't know it yet, or something like that. But these kind of biases are normal. But this is called behavioral finance. How does your behaviors affect your finances? I'll give an example. Here's one to avoid. Herding. Herding is a natural instinct in humans. In other words, in the old caveman days, when you got a big group together, it is much, much safer in numbers.
Safer from predators.
That's right. That's why people when they do seminars as a financial advisor, they get people to come because they're like, well, maybe you won't pick me out. I don't have to answer his questions. I don't have that shark after me, right? Safety in numbers. It's just like when you see these lions going after a herd of buffalo, whatever. It's always the ones on the fringe. The middle of the herd's good, right?
But, when it comes to the market back, a couple crashes ago, you watched people, the tech boom. You go way back to the tech boom. No, I'm not going to do it. It's too risky. It's too risky. Your buddies are making 20 and 30%. They don't know what they're doing. They're telling you you're foolish. Yeah. And, 10,000 in Yahoo turns into 300,000 or something at that point. And eventually what happens? Your emotions, I got to get in.
That's right. I'm missing out. That missing out emotion.
It's the worst time to get in.
And everybody does it. People are flying in the market. If you look at the stock market from 2000, remember, it went way down in 2008. 2009 all the way till about 2016, 15, it was going straight up. The last year and a half, though, it's kind of topped on here. It's kind of like on top of a hill. This is when everybody's jumping in. I see this in not just the stock market. Look at real estate. I don't know one person I know is not considering or doing rental properties or looking at, I'm going to go to that auction place. And now that if you're in that business, those deals are gone because there is so much competition for them. Everybody's got cash and say, I'll give you cash right now, a sight unseen. There's just not many deals. Everybody overdoes it. Everybody jumps in at the wrong time at the end, and everybody overdoes it. Think about hospitals in Dallas. There's a really shortage of them. 10, 20 years ago, you had to wait in line at every emergency room anywhere.
Now there's one on every corner, it seems like, emergent care or whatever.
That's right. They're everywhere. Now, you had a big hospital in Frisco just go out of business. That happens all over because they built too many.
I tell you, I'm thinking as you're talking, another really good reason for having a plan, and when you get a plan, you have to stick with it. If you've got a good plan and it was done common sense, stay with the plan. One of the options we have in the fixed annuities we use is you can have your interest credited by the S&P. You make a percentage of the market when it goes up. You don't lose when it goes down, but people still want to come in and get out. And I always tell them, it's zero when it goes down. Just stay in it. That way you're postured for it when it comes back and quit hopping in and out all the time.
Just think if you had a coin flip that determined whether you made money on an investment or not. Heads, you make money. Tails, you don't lose any money.
Right.
How many times do you want to flip the coin?
Exactly.
Forever, right? And so that's what you have to look at but remember, herding is a big problem. Everybody always gets in at the end. Now everybody's talking. They were talking about tech stocks in the late 90s, even though it started in the early 90s. They're talking about, there was healthcare was a big one. Now it's real estate. They always overbuild this stuff. They'll build too many apartments, build too many houses, then they'll be a glut. It'll crash and then go back up again. It always happens the same. Stay with us, folks. We got a break coming up. We're going to talk more about behavioral finance when we return from the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
By the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you'd like to take advantage of our no obligation, no cost, retirement plan, retirement stress test, Social Security Optimizer, or you just have a financial question, don't hesitate to call our hotline at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. All right. We're talking today about behavioral finance. Our biggest enemy when it comes to investing and success in investing is ourselves.
Can be ourselves.
It's emotion. We talked about the herding bias. As human beings, we naturally believe there's safety in numbers. We wait for our buddies to test the thing first. Here, you drink this poison first. After you drink it, okay. And that's why everybody jumps into the tech stocks later. They're all jumping in full board. They didn't start with 100% tech stocks in 1990. It took to like 1998, 99 to get way up there in value in tech stocks. Same thing now. Everybody's jumping in real estate. Oh, my gosh, real estate will never go down. It'll never go down. Well, I've been in Dallas for a long time, actually most of my life except for the military. And I've seen it go down many times.
It'll go down again.
Yeah, they said, well, apartments can't go down. I've seen apartments, half of them empty many times. Now, that's not the case now. I can't think of anything that's got less of a thing now, but they're building everywhere, and they will overbuild because that's what we do as humans. If we got a shortage, we're going to overbuild till there's a glut, and then it goes down, and vice versa. The cycle continues forever.
But back to the herding question. If you're diversified, if you have a plan, and you've got everything compartmentalized, and you know what you're doing, and you've got your real estate, and you've got your stock market, and you've got your income taken care of with the fixed annuities, it doesn't much matter. We'll go through cycles.
I know. I just bought some properties, and holy crap, what a nightmare. All right. The next bias that you have to fight among yourself is anchoring. Anchoring is one I see all the time. For 30 years, I've seen it. You've seen it, Guy. This is the one thing that people get stuck on. Let's say you own a stock. Let's say it was a company you work for. So you've got inside knowledge of this company, right? You know it's going. And it used to be $100. Well, now it's $60. And you're like, I'll be darned if I ever don't sell that thing till it gets to at least 100. But the problem is there's the analysis paralysis. There's always in a stock. In other words, if it goes from 60 to 100, you're like, well, why are you selling that thing? That just thing made 40% or 80% or something. Well, you don't want to sell it now. But if it goes down, well, I can't sell it now till it gets back to even.
Well, and the problem is, especially if you work for the company, it's like your children compared to somebody else's children. You love all children, but your children are your children. You're emotionally tied to them forever, and they can do no wrong, obviously within reason. And it's the same thing with that stock. You've worked there, you put your life in, you know the company, you know the owner or whatever. It's very difficult to make a common sense decision. You have to step away and maybe get some help.
People do it with stocks. They do it with houses. And when the problem is that high that you experience might not have anything to do with reality. It might have just been more buyers and sellers ran it up, but now it's really the real valuation of the company or the house or whatever.
And no matter how good it is, you shouldn't have all your money in it or all of your retirement money there.
Oh, I get people. And remember, the combination of herding, anchoring, what people do is they'll say, well, this other CD didn't make anything. This stock market didn't make anything last year, but look at this REIT I've got.
Absolutely.
That made 9%. Well, let's just put it all in there.
Yep.
People do the same thing. If they're looking at 401k, do you think they pick the 5 worst mutual funds in the 401k or they pick the 5 best?
5 best.
Every time.
And there was an article in Money Magazine, or about Money Magazine, that said if you read any article, it says the top 10 mutual funds you should own, well, wait 5 or 6 years. They change.
They said that used to be the kind of the rule when you're a financial planner.
What not to invest in?
If you buy the top 10%,
yeah,
within 5 years you'll own the bottom 10%.
Exactly. That's exactly
because
right.
all you're doing is chasing a particular trend. People are smart and still chase the trends because you're like, all right, I got these mutual funds. All right, this one made 1% last year. This one made 9%. Ooh, well, don't want to be that one anymore. Let's go into this one that made 9%. And they basically might be buying the exact same sector of the market.
The problem is
just one sector's going.
Within reason, you've already missed the trend.
That's right. They always say that. What was that? Warren Buffett said, be greedy when everyone else isn't. When everybody else is greedy,
yep,
get out of there.
And that's hard to do, right? Contrarian.
It's really hard to do.
You've got to fight the hurting. You've got to fight the emotion and all the things that are pulling you the wrong way.
And that's what you're talking about. These biases are what prevents people from achieving what they need to achieve. And also, you've got these biases within you. Let's say there's a confirmation bias. Well, confirmation bias is what we do on everything, not just investments. In other words, let's say there's something that we believe, and this from past reading or what we think or whatever, or we really liked one guy that said this was true.
A belief.
Right. And you'll find that you will discount everything negative about that thing, right?
Right.
Everything negative. Well, that's ridiculous.
And look for the positive.
That's right. Then you'll find one that confirms.
Yeah.
That's called a confirmation bias. You'll find one that confirms your particular point of view, and boom, that is the gospel.
I told you so. That's right. Exactly.
I told you. And we'll talk more about behavioral finance when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080. KRL.
All right, the $600,000 deal.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show, folks. Today we're talking about behavioral finance, and these are the kind of things you have to avoid, or definitely try to avoid. Humans are humans. But if you can identify these things, it's easier to avoid the traps and pitfalls. Remember, if you'd like to take advantage of our no-cost, no-obligation retirement plan, stress test, it doesn't matter if you're 40 years old. This stuff will help you. If you're 20, it might be a little premature for that. But everybody 40 and up, probably. 715-2424. Again, 972-715-2424, or go to our website at ilovemyretirement.com. First, we talked about the herding bias, how the safety in numbers, people always get into things at the end before it goes down.
Indeed.
And wonder how come every time I buy something, I must be schleprock like on the Flintstones. Whatever I do is going to
Go the
market's
opposite.
going to the opposite, right? The other one's anchoring. You're stuck to a particular stock price. I'm not going to sell till it gets back to there.
Or portfolio even.
Yeah, any kind of price. Or there's two ways to think about a stock price, okay? I've got people call me all the time. Well, this thing was $20, and now it's $1. Oh, my gosh, what a bargain. I look at the other side. There's a reason it's $1. You know, I don't want anything worth $1. But that's the way you look at it. There's the confirmation bias. Looking through information. Guy and I are real good at this one, by the way. If we've got a disagreement on politics, anything, right?
Yeah.
Well, we could have 200 pieces of evidence on each side. We discount everything that's not in our deal and give them the other one. Hey, what about this right here? That's what everybody does. That's normal. You know, you want confirmation. So if you can get that confirmation, even if the information you're talking about is not really unbiased, you know, there might be underlying reason for it, but people want that. I don't want to go in by myself. As long as I got confirmation from somebody I don't think is the person selling this idea to me,
Yep.
then I'm in.
We've talked about it a number of times. When you do your due diligence on advisors or cars or homes or anything, you really have to look at where the opinions and where the advice is coming from, what that person's background is, what their depth of knowledge is. Do they have a dog in the fight? Do they have any biases themselves? And if you're comfortable with all of that, to me at least, then it gives a little bit more weight or credence to what they're saying. But there's a lot of idiots out there, you know, giving advice.
I'd always tell people, my old saying is, if you look long enough on the internet, you can find 1,000 people that hate puppies.
Absolutely.
I mean, they're crazy.
And they'll give you 100 reasons why.
I know. Sometimes I'll expose that I'm kind of a right-wing kind of Republican type. And boy, the hate mail I get. I'm telling you, people, I hate your voice. I want you. I'm like, whoa, calm down. What the? So you got to be careful there, right? But there's another bias you got to look at. It's the inability to make changes. What happens is, you've heard it before, analysis paralysis. What you'll find is you can have 10 different things of evidence that points, hey, this is probably the direction you should go. One negative that might not mean anything. And you're like, whoop, I'm glad I didn't do that.
But what does that do? That also leads into fear. And they talk about that, speakers, as an acronym, FEAR, fear, false evidence appearing real. And you're scared. And you don't want to make the wrong decision, so you don't make any decision. And perhaps making no decision, indecision, is the wrong decision.
And that's usually what the truth is. Not making a decision is the mistake. But people will do anything not to make a mistake because they've made mistakes before. They're like, not this time. Not this time. And that inability to make a decision is the mistake. I've got people that have 100% risk at stocks, knowing it's probably going to have a correction, because not one time in history did it go up forever. It never will, never has, never will. Yet, their inability to do it, they will take a 20, 30% loss at least in the next few years. They will.
We've had a lot of folks come to us after riding the market down, and it's that herd mentality. When do they get out? After it's already all gone.
Oh, yeah.
And that's not the time to get out.
Everybody jumps in at the top, gets out at the bottom.
Yeah.
So that's just human nature.
Yeah, don't feel bad.
Yeah, you can't feel bad. That is who we are as humans. And a lot of those emotions we have and biases we have were to protect us as a species from the beginning of time. And so I get all that. But when it comes to your money,
fight or flight, baby.
That's right, fight or flight. It can really wreak havoc on your finances. And that's why I told you, I was a nuclear chemist. It's just math. And if you keep it to math, realizing that these emotions are in play.
Just be aware.
Because you have to realize they're in play. You have to know the good part about them and the bad part. If you can do that, then you can be successful in while you're working, during retirement, and everything else. But it's really difficult to do. Just don't get caught up in it. I've got people right now saying, and I said this about tech stocks on the radio when the tech stocks.
Absolutely.
I said it about everything. But now it's real estate. Everybody and their brothers trying to buy rental properties. Do I think they're a good deal now? Sure, I do. Will they be a good deal forever? Of course not. It's just not the way they work. It'd be like the ones I just bought that just cost me $30,000 in a week of owning them.
It's like getting in after the trend. Right now is probably not the best time to be purchasing a rental property. It's a great time to have rental properties. If you wanted to purchase it, you should have purchased it 10 years ago, and now you'd be with the trend. Right. So be diversified. That's all. Just be aware.
And so, excuse me. So that's a little bit on behavioral finance. We're going to have a couple more shows on this later on. There's different ways to frame it that I always thought were pretty interesting. But remember, this show is about answering your financial questions. And so these are questions that came in from emails, from phone calls, and they came from clients, prospects, whatever. And remember, if you have any questions or you'd like to take advantage of our no cost, no obligation retirement stress test, retirement plan, written retirement plan, and Social Security Optimizer, don't hesitate to call our hotline at 972-715-2424. Okay, I think we got time for one.
Or I was going to say, keep in mind with this behavioral finance, if you have a plan in place, and we can go through that analyzer and we can outline exactly what income you'll have, including your Social Security and your pensions and some income. It just makes it easier for you and removes the emotion.
That's right. If you can remove that, and that's why having a written plan helps you more than just theoretically, I think it will do this if I do this. Don't hesitate to call us at 972-715-2424. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions you'd like to take advantage of our no-cost, no-obligation retirement plan, stress test, written retirement plan, and Social Security Optimizer. Also remember, we do your homeowner's quotes, car insurance quotes, your business insurance of all types. You can have one advisor to have all your insurance needs covered. Don't hesitate to call us at 972-715-2424. Again, 972-715-2424. You can always go to ilovemyretirement.com. For the break, this show, we've been talking about behavioral finance, and now we're answering your financial questions. Remember, if you have any financial questions, don't hesitate to call us. What's our first question, Guy?
All right, question number one. I can't get my wife to understand that you have to take risk to keep up with inflation. Could you help her understand?
Well, I mean, I get that normally, you're not going to get there at a 1% CD, very often. But there are ways to kind of cover both. We've talked about it before, maybe an index annuity, which gives you up years of indexes, no down years. They've changed a lot in the last just few years. The biggest knock on index annuities, the income, anybody that's knocked them is an idiot because they pay more income per dollar than anything I know. It's the knock on growth. Right. In other words, you are capped out on your growth. Yeah, okay, I got it, I'm safe, but they're only letting me make 5% or something, right? Well, they've come up, all the new things the last probably year or two has been no caps. I'll let you make 100% of an index on up years, no down years. And what they did was maybe we take the first 1.5, you get the rest. So if it makes 10, I get 8.5. Yes.
Which also means if the market doesn't make anything, there's no fee.
That's right. That's why it's called a margin. Margin is kind of like profit sharing. We get the first 1.5 of profit, and that's not bad. If we're guaranteeing I'll never take a down year. I don't care if it goes down 50%, I can't take a down year, and it's tax deferred, and it's judgment proof. And so normally, yes, to make more profits, to keep up with inflation, you have to take risks like the stock market, which I like. But if you're a person that's trying to look for a hybrid, an index annuity or even an index universal life is a good option for that.
And I do think by nature, women are a little bit more adverse to risk. Maybe it's the maternal thing or whatever. But when I get a question like that, sometimes I wonder if the guy being aggressive and immortal like we are, right, especially when we're younger, isn't thinking of putting all of the portfolio in the market. And she's going, no. So the other deal is, if it's balanced, it's not as much risk. If you sit down with her and you've got the plan that we've been talking about, you've got your income taken care of, you've got that perhaps in fixed annuities, you've got some bonds, you've got the emergency fund, and now you're just presenting some managed money or a balanced portfolio to her. It's a little bit easier for her to understand because you've got the whole gamut, you've got the whole plan, it's modeled, and that may help as well.
You can also have a managed stock program with an exit strategy, exit feature, hedge type feature.
Absolutely.
We have that, a very good one. It's in every sector of the market. There are 10 sectors of the S&P. It's in those, plus fixed income and alternatives, stuff like that. But if any of those sectors go below their moving average, they're automatically out of that sector. So it's kind of have a built-in protection feature. They're 100% liquid. All of our accounts are at Fidelity. That's a decent option also for helping you. I'm trying to cover you and your wife. Getting a little better return to cover inflation, but at the same time, protecting the assets. Absolutely. And if you have any questions about that or like some no obligation information sent to you, don't hesitate. It's 972-715-2424. Again, 972-715-2424. All right, what's the next question?
All right, here's an easy one, front and center, almost every day on the news. Do cheap oil prices really destroy the economy?
A lot of the economy is based on oil and the oil business. I mean, I've got friends and relatives that are in the fracking thing and making a fortune when it was going up, right?
Yep.
Now, not so much, but
you got the Clintons and a certain group trying to get rid of the coal industry.
That's right. So some industries it definitely does hurt, but there's a lot of others that benefit from it. Yeah. Think about what the airline industry is making now by the cheap oil, right? Every American is saving hundreds of dollars a year just from the gas prices being lower. And theoretically, they have hundreds more to spend into the economy. But there's usually a healthy balance. I don't think it's this oil, but maybe $50, $60 a barrel might be a healthy balance of the two. So cheap oil prices don't destroy the economy. They hurt some aspects of it, but not destroy it.
There's always two sides, right? You've got benefits and you've got negatives, and you have to kind of balance it and see where you
have a lot of clients that own oil companies, and they would say, no, it does destroy. Don't be saying that on the radio.
No, we need $100 oil.
That's right.
I heard something on the news the other day that like $47, $50 oil just kind of bleeds them slowly dry. I couldn't believe that wasn't enough.
Depends on their operation.
Lifting cost and all
some
that.
are break even at $30, $35. Some at $60, $70. All right, what's our next question?
All right, next question is, my advisor stated that he used to offer indexed annuities, but his clients weren't happy. They said that they expected better returns. Why should I consider them now?
Well, first off, I've never heard of somebody offering index annuities and not selling them anymore. I've never heard of that. But I have heard of some wirehouse people that started, wirehouse be the big firms, and they were basically given expectations of huge returns. Index annuities are fixed income.
Because they didn't understand.
That's right. They didn't understand them. Even though you can make double digits, and I have many times, they're designed to maybe make 46, 47% and not have risk in your money. That's really what they're designed for. And if you're sold properly, they can be a fantastic addition to your portfolio. Well, that's our show, folks. We're going to answer a lot more of your questions on our next week's show. If you have any financial questions, like to take advantage of any of our services, don't hesitate to call our hotline, 972-715-2424, 972-715-2424, or go to ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.